Hey, good morning, everyone. Marty Mazzora here, February 27th, 2025, Thursday, coming at you early this week with the end of week video. I thought I'd talk at you a few minutes this morning when I had the chance the next few days. The schedule is somewhat full, although I will definitely find the time to do the weekend macro work. Just concerned that I wouldn't have enough time to put together a good video for you. So I think there's enough going on and certainly enough on my mind to go ahead and do that now. So what I'm going to do is just ramble for a few minutes about my thoughts of what's been going on, the latest developments, a conversation I had with an analyst yesterday, and then just take a quick look, as usual, at equities, the dollar, yields, and gold. So with regard to the current dynamics in the market, I know most people, first and foremost, they look at the equity markets, and they have been mostly down the last few days. Of course, different people look at different indexes. I still find that a lot of people focus still on the Dow because that's kind of old school. The Dow Jones Industrial Average was what we used to talk about. Even though it's still just 30 stocks and you can get a good or bad earnings announcement, for example, on one company, and that can do a major number in one direction or the other on the index. This morning's a good example. The Dow is, as I speak, up 383 points. But the S&P 500, which of course is 500 stocks, is flat as a pancake. And the NASDAQ 100 index, which is where the big movers and shakers trade, is actually down close to 0.5% so far this morning. So just to get a feel for the overall market and what's going on today. Now, the fact that the NASDAQ is down is interesting because that no doubt is influenced very much by NVIDIA, which actually started the day nicely higher, but it's down 3% as I speak at you right now. Now, NVIDIA announced its earnings yesterday, and it came in better than expected, I think, on top and bottom lines, but it just wasn't that kind of rip your face off crazy good number relative to expectations. I haven't yet read the script from the conference call. Typically, NVIDIA CEO exhibits incredible optimism about the present and the future for the company and so on. And as I said, somewhat sarcastically in yesterday's written blog, we'll see if he does his thing and can effectively pump the stock higher. Not to say that it doesn't deserve to be pumped higher, just telling you kind of how I see it. With this particular CEO and this particular company. With regard to NVIDIA, it is obviously representative of the entire AI space, and we do have some concerns. From what we hear, Microsoft is canceling a bunch of data center build-out plans. We think the Chinese DeepSeek story is one thing that's causing some hesitation. Another is just the ability to monetize these billions and billions of dollars that are being invested in artificial intelligence. Will it basically be a story like virtually all the great technology since the beginning of time? And that is, you get this wonderful new idea, this wonderful new technology that's going to change the world, and it typically does. But then you get massive and massive amounts, at least initially, of capital invested into it. And you have massive, overcapacity, and the majority of the players fail. But the big, solid, smart players survive. At one point in the early 20th century, the U.S. had 10,000 car makers in the country, believe it or not. And we all know the dot-com scenario too, and I don't know how the AI thing is going to play out. I do believe that it is world-changing. We are using it daily in our business and finding great value in it, but we're not really paying any consequential amount of money for it, to be honest with you. So I think that's the big problem, is that it's open source. I think that's the right term. And it's available, and basically everybody's competing in exactly the same space, and who's going to bring value enough to warrant a big premium for it. I think the benefit is going to be like the internet. It's going to create massive productivity for companies. And it's not necessarily the producers of the AI miracle itself, it's the ones who actually use it, right, and benefit from it. So I do honestly anticipate the same sort of story that has explained, the rise in great technology and then the fall of many of the players within that space. Time will tell. It'll be very interesting to watch this evolve over the next few years. So I mentioned that I had a conversation with an analyst. It was a one-on-one conversation with a top analyst with one of the firms who we pay for their deep research. This particular firm is more optimistic than we are on the economy going forward. And they cite a lot of statistics that we crunch every single week in terms of current state of the consumer and so on. And they just don't see much of a chance at all of a economic downturn or a recession during the course of 2025. We're not hugely in the recession camp. As I've mentioned, our own indicator scores neutral currently, but I'm less sanguine on the economy than this particular firm is. The interesting thing is, though, is that we are very much in line with our allocations and our expectations where we think probabilities lie in the equity markets globally. They are very cautious U.S. equities. They say that they are essentially priced for perfection or no margin for error at these levels. They're more bullish on, for example, European equities and so on, relatively bullish on inflation and therefore the commodity complex and so on going forward. So it's interesting that we don't necessarily share their view on the macro, but on the actual asset allocation, we do. So here's a firm who actually says the economy is going to stay relatively strong. Therefore, inflation and yields are going to stay relatively high. And that will be a serious headwind for U.S. equities going forward. Kind of feels like 2022 in their scenario, and that is where stocks went down 27%, peak to trough. In the S&P, 37% for the NASDAQ, and it was not amid recessionary fears. It was amid inflationary fears and higher interest rates. Well, it's a different world today because now every headline, or the one that's concerning markets, has to do with tariffs, and there's a lot of confusion there, and I think it's confusing the market. This morning, for example, the president's chief economist basically told, I believe it was CNBC, I heard this on another interview, that the tariffs on Mexico and Canada are going to start in April, and I don't believe he made mention of anything in China. Literally minutes later, the president said that the tariffs for Mexico and Canada will begin March 3rd, next week, and we're adding another 10% tariffs on China. So when that came out, that was in the pre-market. Stock futures rolled over. They were up pretty nicely. The NASDAQ was up, NVIDIA was up, and on that announcement, the latter one, stocks rolled over, and they're just kind of struggling right now to find their way, at least on the day. Right now, S&P is down a little bit, and the Dow is still up, 316 points, and that would be company specific. Again, there's only 30 stocks in the Dow, and the NASDAQ is down 0.75%, and foreign stocks are down notably. Europe's down 1.16. I think European tariffs are coming, or at least the threat of those are coming. Gold, which has been great for us for quite some time now, is down 1.5%. We'll talk about gold here in a second. Now, gold and European equities are largely explain how our core portfolio, that's only 56% allocated to stocks, has actually outperformed the equity markets. That's not our benchmark, the way we invest, but that's just as it has so far this year, fairly noticeably when we look at like the Dow and the S&P. But again, it's because we've been in other places. Well, we still like those two areas that I just mentioned longer term, but we do have some shorter term concerns, and I've been mentioning that about gold specifically. So when they're a little bit higher, we bought some relatively cheap insurance relative to what we're insuring and use some options to protect those positions for the next few months, meaning protect them against massive double-digit declines. Definitely we're seeing gold go down in our portfolio today. It's got to go down more before these options really kick in, but it does put a floor so that we can't get stung too badly if these things correct, like all securities tend to do. Our view of the world and of the technicals in particular with gold, as I mentioned last week's video, and I will here in a minute, that looks real suspect to me. And then one other thing I want to mention too, and this was the conversation that I had with the gentleman yesterday, in that I said, do you think much about reflexivity? And what I meant by that is clearly, and their statistics show this, our statistics show this, article in the Wall Street Journal this week shows this, that it is frankly rich folk who are doing virtually all of the heavy lifting on consumption in the economy. I mentioned the Wall Street Journal. The title of the article is "The U.S. Economy Depends More Than Ever on Rich People." Top 10% of earners, households making above $250,000 a year or more, are splurging on everything from vacations to designer handbags, buoyed by big gains in stocks, real estate, and other assets. Those consumers now account for 50% of all spending, a record in data going back to 1989. That's a concern, to be honest with you. If this market, which is priced for perfection, and this is where people have a lot of their money, as I understand it, stocks make up a higher percentage of household net worth than they ever have. If indeed this economy is living on the consumption of folks who feel wealthy, the so-called wealth effect, if they start to feel less wealthy because the market's correct, that could be the catalyst. In the concept of reflexivity, essentially the stock market actually leads the economy, and these are the kind of conditions where that makes a lot of sense to me. So I mentioned this to the gentleman. He said, yes, we are looking at that, and he had a lot of yeah buts, but I think it is something we need to be very, very focused on. So rather than the stock market declining, discounting a recession in the offing, the stock market declining can actually create the recession in this scenario. So again, just another risk that we need to be cognizant of, and which also says do not, load up on stocks, be very diversified, and hedge those areas that you're making money in, but they look like they are suspect to something dramatic to the downside. Thank you for listening to me ramble all that time. And here is the S&P 500 daily chart. Remember last time I looked at this 50-day moving average. I said on the written blog yesterday that we've failed the breakout here to all-time highs, and the S&P is curling down below its 50-day moving average. You don't really want that to get broken. It's broken right now, but there is a whole lot of air between there and the 200-day moving average. This chart looks very, very suspect, at least on the daily. But again, some good news on tariffs being delayed again or something like that, and we could easily shoot back up to all-time highs. I showed you last time bearish engulfing candles on the weekly and how those tend to play out quite a bit more negatively than we've seen so far. So that's something technically that has our attention as well. On the NASDAQ 100 index, similar thing. It broke its 20-day moving average, which has been good short-term support for it, and it's now broken the 50-day moving average. This is beginning, if we typically, you would snap back and test that 50. If it did that and then failed, we'd have a bear flag pattern, and I've shown you that they tend to play out probably more often than not. Here's some bear flagging right back in here last year for the NASDAQ that played out right to target. So we'll see. I wouldn't really call it that just yet. It just wouldn't surprise me. That's what I'm used to seeing, is that get a rally maybe over the next day or three, and then if it doesn't pierce back above that 50-day moving average, then we're going to be talking about quite a bit lower here on the NASDAQ. Again, the right kind of news. Right now, all the news is coming out of Washington, and the market could come roaring back in a hurry. The dollar as I mentioned in the written blog, the correlations have kind of gone south, meaning the dollar had been going down here in a trend as the stock market was going down. You can see we're getting a big boost in the dollar today. That would be on the tariff news. If you announce that tariffs are imminent, then the currencies of the tariffed countries are going to almost immediately decline, and that is essentially an offset to the impact of the tariff. So you can see the dollar's having quite the day today, and despite that, the Dow is still up about 300 points, but the S&P is now in the red a little bit, and the NASDAQ is still down, about what I said a minute ago. Yields, here we have yields falling. I talked about this yesterday on the written blog, but we don't have stocks rising, which has been the normal correlation, right? Yields are falling because this is fear over the economy. Jobless claims spiked a little bit today. They're still not at scary levels, but Wall Street made a big deal out of that. The prospects for a big trade war, make no mistake, that is negative news for the economy. So this is yields reacting to the prospects for a weaker economy going forward. You can see how we had a bear flag pattern right here that played out, pretty much to target. If you want to go longer term, this looks very much like a bear flag pattern to me. And that takes yields down to close to where they are right now. So we'll see if we don't get a bounce. I said, I think last week, that technically it did look to me like we could see a bounce, although that those bullish divergences are gone. So I wouldn't make that case like I did here the other day with yields dropping. And again, nobody should be complaining about lower interest rates. It's just the reason they're dropping right now would be of concern to people. And then lastly, gold. Remember I said here 3 or 4 days ago that we are long-term bulls on gold, but we have hedged our position a bit because this looks like it is ripe to roll over, and it has. Since I said that, that's a sell signal, and we had that bearish divergence on the RSI. So as I type, gold is down 1.5% today. We'll see. I think it could go lower, and we'll feel it in our portfolio, but we're hedged to the point where we can't get consequentially hurt by it in the near term. So folks, in a nutshell, a lot of uncertainty. If Washington really makes good on the kinds of tariffs that they're talking about, markets globally, U.S. and non-U.S. equity markets, are not going to like it. You might think that that would be good for gold because of the uncertainty, and I think ultimately yes, but today we're kind of getting this whole risk-off mode, and that is people just selling assets that they've made money in because they're starting to get concerned about things. The strong dollar, of course, is all by itself would suggest weaker gold, so maybe that's the excuse for gold being down so much today, is that the dollar's up so much today. And then we just need to consider the fact that if indeed it's people who own assets that are keeping this economy chugging, well, as their assets decline, so will their economic activity, I can assure you. And so lots to parse and to work through and keep our eye on in the weeks and months to come. I've been mentioning to clients who are very happy with their year-to-date results, and I said yes, but let's just acknowledge that in this environment, there's going to be a ton of volatility as we work our way through this year. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend, and I'll be back soon. Take care. Bye-bye.